figures. So effectively, we've implemented MergeCo into our numbers for the first time, given AP Eagers is now over 90% and therefore will compulsory acquire AHG. As you can see there, we've talked a lot about AP Eagers being a preferred pick. Obviously, it announced the merger back in May. It has performed, exceptionally well, up 50% since then. But I guess we've kept an ad rating in this report, so I just wanted to touch on why I think there's more to come here. So if we just look at MergeCo, so AP Eagers have articulated around $30 million worth of synergies in year one. So $13.5 million in the first 6 months, which really relates to the duplication of head office kind of functions, and then another, the balance of that $30 million over the course of that second 6 months. So all in the first 12 months. So of course the next question is, well, what does tranche 2 look like? And we've tried to set that out in our notes. So if you just look at that, look at the report or look at that table up on the board there. So effectively, APE's exceptional last half result was because it actually took out a fair few heads in its dealership business, and not just taking out heads for the sake of it, but making a more efficient business for the way it's going to run this business in the future with the likes of auto malls, etc. So we've said, well, what if they take out 5% of AHG's dealership people in the first, or in the next couple of years? There's $30 million we think they can realise. And then if you look at AHG's total dealership workforce versus AP Eagers and look at their employee costs, you can see that AHG employee cost per head is a fair way ahead of AP Eagers. And so we've said, well, if they can bridge that gap halfway, then there's another circa $75 million of synergies we think they can take out over time. That last little bit relates to bailment finance. So this is how every dealership company funds its fleet. And AP Eagers' rate is certainly a fair way below AHG's for obvious reasons. So if they can just tweak that even by 50 basis points, there's another $5 million. So effectively, we're saying that there could be $109 million of upside here. Some of that, however, will be encapsulated in that original 30. So we've said basically that the upside, or the bull case total synergies, is probably $123 million. Stapling the two businesses together, and again, this is all in our report. So effectively, we've assumed that $30 million of synergies in the first 12 months, and then we've assumed an incremental $15 million per annum. So by the time we get to calendar year 24, we've assumed $90 million of synergies in total, including that original 30. So well below our bull case scenario, and we think that hopefully should be quite conservative. We've removed our refrigerated logistics from our numbers. We assume that gets sold next year. Martin said clearly he wants that gone as quickly as possible. We've assumed that's sold for $150. Remember, there's $100 million of finance leases in that business, so any cent they sell that for over $100 million is cash back in the door. So effectively saying $50 million of cash comes back. And we've only assumed moderate margin uptick for both businesses. So we're not having to rely on some major cyclical upturn here. We're saying that both businesses have reset cost bases to account for a cyclical low point, and that broadly kind of continues. As you can see there, though, from calendar year 21, which is where the market will look to pretty quickly, we can kind of see 3 years of almost like 10% EPS growth on offer here, a PE in the 17s and a 4.2% yield, and we don't get scared by that at all, and we think the market will be okay with that. Just on the balance sheet, we've been talking that for some time. So as at 30 June, there's about $440 million pro forma net debt between the two businesses. But since then, AP Eagers has announced another $170 million of property and asset sales. It will sell refrigerated logistics, as we said. And then we factor in the costs associated with some of these synergies, the redundancies, etc., the tax payable on some of those property sales, and the cash generation of both combined businesses. We get to around $160 million net debt by the end of calendar year 20. So considering the quantum of EBITDA in that business, that's what we'd consider to be an under-geared balance sheet. AP Eagers has nearly 200 million franking credits, AHG 120, so we would think capital management is likely at some stage. If you're thinking about the quantum of capital management, I would have thought a buyback more likely, but perhaps a mixture of specials and a buyback over the next 12 to 18 months. Index inclusion is important for institutions, and we need to be aware of it too. So it'll be a $3.5 billion market cap, about 73% free float. So Nick Politis will be the only insider of a substantial nature in the company. So post the merger being effected, because the last 6 months have been nonsensical for both stocks in terms of liquidity and trading, we think the S&P is more likely to look at the last 8 weeks post the deal being effective, like it does for any new company that hits the board. So on that basis, the stock ranks about 102 actually, so it's well and truly should be able to go into the ASX 200, providing liquidity is there, which we think it should be. So just lastly on the valuation, so our DCF comes out at 16 odd dollars, some of the parts at 15. If you look at the multiples we've paid there and what the PE it implies, we still don't think that's a major stretch. We're probably asking that the PE is held at that odd 20 odd times, which we don't think is a big ask. And just on why we've kept the buy, I suppose, just with the more catalysts we see on the horizon, despite it already having rung strongly, I would just be urging people not to be too trigger happy and letting some of these things go, because this is now a multi-year earnings growth story and backed up by real synergies that AP Eagers will extract. You've got the index inclusion, you've got the sale of refrigerated logistics, potential capital management. We haven't factored anything in for auto malls yet, and he's saying that's a 20% cost efficiency within AP Eagers. We haven't factored anything in for finance penetration lifting up to 80%, which he has said if they can do that could increase their earnings by 50% within AP Eagers. So and all that comes down to an extremely strong management team that has the ability now to better manage an underperforming AHG business.